If you find this video helpful, please don't forget to like, share, and subscribe. A stock split is a direct and effective tool to lower the entry barrier, inviting more people to participate in the company's ownership and potential future success. Another primary driver behind the decision to split a stock is the goal of increasing liquidity. In financial terms, liquidity refers to the ease with which an asset, in this case a share of stock, can be bought or sold in the market without causing a significant change in its price. A stock with high liquidity has a large number of buyers and sellers at any given time, resulting in a high volume of daily trades. This is beneficial for all investors. When liquidity is high, it is easier to execute your trades quickly and at a predictable price. You can be more confident that when you decide to sell, there will be a ready buyer, and vice versa. A stock with a very high price per share can often suffer from lower liquidity. The pool of potential buyers who can afford to trade in whole shares is simply smaller. This can lead to a wider bid-ask spread, which is the difference between the highest price a buyer is willing to pay for a stock, the bid, and the lowest price a seller is willing to accept, the ask. A wider spread means it costs more to trade the stock, as the transaction price is less favorable. By splitting the stock and lowering its price, a company dramatically increases the number of shares available for trading and makes them accessible to a much larger pool of potential buyers and sellers. This increase in the number of market participants naturally leads to a higher volume of trading activity. With more shares changing hands each day, the bid-ask spread tends to narrow, making transactions more efficient and less costly for everyone involved. Think of it like a bustling marketplace versus a quiet, deserted street. In the bustling market, prices are competitive and transactions happen quickly. On the deserted street, finding a trading partner is difficult, and you may have to accept a less than ideal price. A stock split helps turn a quiet street into a bustling market by creating more, smaller-priced goods that more people can afford to trade. This increased liquidity is particularly attractive to institutional investors and market makers who need to be able to buy and sell large blocks of shares without drastically moving the stock's price. A more liquid market provides them with the stability and efficiency they require to manage large portfolios. For the individual investor, this heightened activity means their own smaller orders are more likely to be filled promptly and at a fair price. By making the stock easier and cheaper to trade, the company enhances its overall appeal as an investment vehicle, which can contribute to a more stable and efficient market for its shares over the long term. Beyond the practical benefits of affordability and liquidity, a stock split often serves as a powerful, albeit indirect, signal to the market. It is a public declaration of confidence and optimism from the company's board of directors and executive leadership. Companies don't typically split their stock when they are struggling or when they foresee a period of decline. The very situation that necessitates a split, a stock price that has risen so high that it has become unwieldy, is itself a product of success. It means the company has been performing exceptionally well, delivering strong results, and earning the trust of investors who have bid up the share price over time. By executing a split, the management team is effectively sending a message to Wall Street and individual investors alike. The message is, our company has grown significantly, and we believe this growth is sustainable. We are so confident in our future prospects that we anticipate the stock price will continue to appreciate from its new lower base. It implies that the leadership believes the underlying business fundamentals are strong enough to support continued upward momentum even after the cosmetic price adjustment. This act can generate positive sentiment and reinforce the perception of the company as a healthy, thriving enterprise with a bright future ahead of it. This signal can create a self-reinforcing cycle of positive investor psychology. The announcement of a stock split often generates a flurry of media attention and analysis from financial news outlets. This publicity puts the company in the spotlight, reminding existing investors of its success and introducing it to potential new ones. The narrative often frames the split as a reward for past performance and a vote of confidence in future growth. This can lead to increased buying interest in the period leading up to and immediately following the split, as investors anticipate that the increased accessibility and positive sentiment will drive the price higher. Of course, it is crucial for investors to remember that a stock split is just a signal. It is not a guarantee of future performance. The confidence of the management team must be backed up by continued execution, revenue growth, and profitability. However, in the world of investing, where perception and sentiment play a significant role, Such a strong signal of optimism from the very people who know the company best can be a powerful catalyst. It serves as a symbolic milestone, marking a period of significant achievement and communicating a clear, forward-looking message of strength and ambition to the entire investment community.